Money is supposed to make the world go round. But lately, it feels like the gears are grinding. Inflation cools, yet prices never fall. Markets rise, but so does debt. Banks boast record profits even as ordinary people can't afford a home. Something doesn't add up, and maybe that is because the next financial crisis eyes into coming. It's already here, hiding in plain sight. Every era of finance begins with confidence and ends with illusion. After 2008, governments swore never again. Banks were reformed, regulators were armed with new tools, and central banks became gods of money printing, buying, and stabilizing everything in sight. For over a decade, it worked. The world bathed in cheap credit and rising markets. But confidence is the most fragile currency of all. By 2020, when the pandemic struck, the illusion cracked open. To keep the system alive, the Federal Reserve, the European Central Bank, and others unleashed a tidal wave of money. In just months, they printed more currency than in the entire decade after the last crisis. The result wasn't stability, it was acceleration, inflation, speculation, and distortion. Now, as governments pull back the tide, we're discovering what was really built beneath the surface: a global economy addicted to zero interest rates, unable to live without them. Financial crises never arrive as strangers. They echo. The panic of 1929 began with too much optimism. The collapse of 2008 began with too much debt. And both began with the same human flaw, believing this time is different. In the 1920s, cheap credit fueled a decade of excess. Americans borrowed to buy stocks, cars, and dreams. When confidence cracked, the house of cards fell, dragging the world into the Great Depression. Fast forward nearly a century, and the pattern repeated. The 2000s saw mortgage-backed securities, subprime loans, and the fantasy that risk could be engineered away. When the illusion shattered in 2008, entire economies froze. Lehman Brothers collapsed. Trillions evaporated. But instead of learning, we rebuilt the same system, only bigger. Debt didn't shrink, it multiplied. Banks didn't shrink, they merged. And central banks became the ultimate insurers of risk. The result? A global economy where markets only rise if money keeps flowing and collapse if it stops. So, what does a financial crisis look like when no one admits it's happening? It doesn't start with crashing stock markets or long bank lines. It begins silently through the cracks in ordinary life. Rent doubles, grocery bills triple, savings lose value faster than people can earn. Meanwhile, asset stocks, housing, even art soar to absurd heights. This isn't prosperity. It's distortion. For years, central banks promised to tame inflation without breaking the system. But monetary policy isn't magic, it's leverage. When rates rise, someone breaks. And in 2023, it began. Regional banks in the U.S. started to crumble: Silicon Valley Bank, Signature, First Republic. Each one failed not because of fraud or corruption, but because they believed the world would stay frozen in the low-rate era forever. Meanwhile, in Europe, energy shocks, political instability, and debt burdens expose old wounds. Nations like Italy, France, and even Germany struggled under new pressures. While developing countries face a tsunami of dollar-denominated debt they could no longer repay. The crisis isn't one explosion, it's erosion. Confidence slipping, debt rising, trust fading. Economists love clean definitions. A recession is 2/4 of negative GDP. But real financial decay rarely fits neatly in the formulas. Look around, global trade is slowing, manufacturing is in decline, productivity stagnates, yet asset prices remain bizarrely high. That's not growth. That's denial. We're living through what some analysts call the silent recession, where real wealth shrinks even as paper wealth grows. Corporations buy back their own stocks to appear strong. Governments borrow endlessly to avoid the pain of austerity. And individuals stretch their credit cards to survive inflation that never truly disappears. It is not that the world is broken, it's that the illusion of money has detached from reality. This is how crises evolve now, not in fire, but in fog. To understand this moment, We have to look back at the times the world thought it was rich right before it discovered it wasn't tea. In 1720, London erupted in what became known as the South Sea Bubble. Investors believed a company had exclusive rights to trade with the Spanish colonies in South America. In truth, it was mostly fantasy. Shares rose 1,000%, then collapsed overnight, wiping out fortunes and reputations, including members of parliament. 2 centuries later, Japan repeated the pattern. In the 1980s, the Nikkei soared, and Tokyo's land was valued higher than the entire United States. Then came the 1990 crash. The bubble burst. Japan entered what became known as the Lost Decades, 30 years of deflation, stagnation, and unfulfilled promises. And now, the global economy resembles Japan's bubble on a planetary scale. Every asset class inflated by cheap credit, from Silicon Valley tech to Chinese real estate to crypto markets that turn speculation into religion. We keep calling it innovation, but history calls it hubris. The modern crisis isn't about banks or governments anymore. It's about the nature of money itself. For centuries, currency was tied to something real: gold, silver, or tangible goods. Today, money is purely digital, created with keystrokes, backed by confidence alone. Central banks can summon trillions at will. But what happens when belief in that magic fades? In 2020, the world's balance sheet expanded beyond comprehension. Debt exceeded $300 trillion, 3 times global GDP. That's not just leverage, it's dependency. Every economy, every corporation, every citizen is now entangled in the same web of endless credit. And like any addiction, withdrawal is painful. Rising interest rates are now exposing who was swimming naked. Zombie companies, those surviving only because of cheap loans, are collapsing. Sovereign debt, from Argentina to Sri Lanka, teeters on the edge. Even the U.S. faces rising deficits that no longer shock anyone. We've entered an era where printing money no longer guarantees stability. It guarantees inflation, inequality, and eventual reckoning. So, where does this lead? Not to one giant crash, but a series of rolling crises, sector by sector, nation by nation. First, housing as affordability disappears. Then, banking as liquidity dries up. Then, governments as debt becomes unpayable. In many ways, it's already happening. China's property giants default. European factories shut down. American consumers drown in credit card debt surpassing $1 trillion. Emerging markets spiral as the dollar strengthens. And yet the markets rally, because belief hasn't broken. Not yet. The stock market still dances to the rhythm of liquidity, not productivity. Investors still chase yield, not value. And central banks still whisper that they'll step in if things get bad enough. But what happens when even they run out of room to maneuver? That's the moment confidence dies. And when confidence dies, money itself begins to decay. Behind every financial chart is a human story. In 1929, it was the farmer who lost his land. In 2008, the family who lost their home. Today, it's the worker who earns more than ever but can afford less than before. The new crisis doesn't look like panic. It looks like exhaustion. People working longer hours for diminishing returns. Young generations realizing they may never own a home. Retirees discovering their savings no longer keep pace with the cost of living. It's a quiet kind of collapse, psychological, not just financial. A society losing faith in the system that once promised prosperity. That's how all great financial empires begin to crumble, not through riots or revolutions, but through disillusionment. Crises are not destiny, they are choices deferred. History shows that renewal always follows collapse, but only after humility returns. In the 1930s, reform rebuilt the banking system. In the 1970s, after the oil shocks, new financial frameworks emerged. In 2008, global coordination prevented total chaos but failed to fix the root cause. This time, fixing the system means confronting uncomfortable truths, that infinite growth on finite credit is impossible, that money creation cannot solve structural decay, and that real wealth productivity, innovation, stability must return to the center of finance. But change rarely comes willingly. It comes through necessity. And necessity, it seems, is arriving once again. Every generation believes it has tamed the cycle. Every generation discovers too late that the cycle tames them. The next financial crisis isn't a storm on the horizon. It's the water already rising around our feet. The signs are everywhere: inflated assets, silent defaults, and governments drowning in their own debts. The system won't collapse overnight. It will corrode one policy, one bailout, one broken promise at a time. And by the time we realize it, the world of money may already have changed into something unrecognizable. But perhaps that's not just a warning, it's an invitation. An invitation to learn, to question, and to prepare for the financial world that's already unfolding. Because the next chapter of economic history isn't waiting to be written. It's being written now. Money has always been more than paper. It's trust, power, and illusion, all in one. And as that illusion flickers, the question I ask Tindy if another crisis is coming is whether we'll recognize it before it's too late. If you found this story thought-provoking, consider subscribing, because understanding the past may be the only way to survive the future.